In the world of finance, we often hear the mantra that assets should always outweigh liabilities. It's a simple equation that seems to govern our understanding of wealth and stability. But let's take a moment to peel back the layers of this idea, especially in today's increasingly complex financial landscape. As we navigate through rising debt levels, unpredictable market conditions, and a global economy that feels more like a roller coaster than a steady ride, understanding how to truly value our assets and liabilities is more critical than ever. So, what exactly is an asset? At its core, an asset is anything of value that can contribute to your financial well being. It could be physical, like a house or a car, or intangible, like intellectual property or brand recognition. For businesses, assets are the lifeblood. They generate income, facilitate operations, and provide security. Think of current assets as the cash in your wallet or the money owed to you by customers. These are your short term lifelines, essential for covering immediate expenses. Now, fixed assets, on the other hand, are more like the sturdy foundation of a house, land, buildings, machinery, things that provide long term stability and revenue generation. But let's not forget about financial assets. Stocks, bonds, real estate, even cash, these are the investments that can grow and appreciate over time. They're the tools you can leverage to build wealth. Intangible assets, such as trademarks and customer relationships, also play a vital role. They may not be physically touchable, but they hold significant value in terms of future cash flows and business potential. Now, let's shift gears and talk about liabilities. A liability is essentially a financial obligation, something you owe. It could be a loan, credit card debt, or even a contractual obligation. Liabilities can come from various sources, and they can weigh heavily on your financial health if not managed properly. Current liabilities are the debts you need to pay off soon, like credit card bills or rent. In contrast, non-current liabilities are those longer-term debts, such as a mortgage or long-term loans. Understanding the difference between assets and liabilities is crucial. It's like knowing the difference between the things that provide you with financial security and the things that can drag you down. Investors tend to prefer assets because they offer potential returns and security. Owning an asset means you have something of value that can appreciate, generate income, or be sold if necessary. In contrast, liabilities often represent a risk, money you owe that could hinder your financial flexibility. Let's dive deeper into why assets are generally seen as more valuable than liabilities. First and foremost, assets provide income and security. If you have a loan, that's a liability that requires regular payments. But if you own a rental property, that's an asset generating income each month. Even if you have debts tied to that property, the income it produces can help you manage those liabilities. Next, assets tend to appreciate over time, while liabilities often don't. With inflation and market fluctuations, many assets like real estate or stocks can increase in value. For instance, if you buy a house for $200,000 and over 5 years it appreciates to $300,000, that's a significant gain. On the flip side, liabilities like credit card debt generally don't appreciate. They remain static or even grow due to interest. Assets also provide leverage. If you want to take out a loan, having substantial assets can make you a more attractive borrower. Lenders are more likely to extend credit to someone with valuable assets because they see less risk. Conversely, high liabilities can hurt your creditworthiness, making it harder to secure loans or favorable interest rates. Liquidity is another key factor. In financial terms, liquidity refers to how easily an asset can be converted into cash. Stocks and bonds are typically liquid. You can sell them quickly if you need cash. However, liabilities don't offer this flexibility. If you're burdened with high debts, you may find yourself in a tight spot during emergencies. Finally, owning assets gives you control over your financial future. They empower you to make decisions that can lead to wealth accumulation. You can sell, trade, or leverage them as collateral for loans. Liabilities, on the other hand, often come with fixed terms and conditions that can limit your options and flexibility. Now, let's talk about the hidden benefits of owning assets. Financial stability is a significant advantage. Tangible assets like real estate or stocks can provide a safety net during economic downturns. They can grow in value, offering you options for retirement or other long-term goals. Less stress is another hidden benefit. Managing liabilities like student loans or credit card debt can be overwhelming. The pressure of regular payments can take a toll on your mental health. By focusing on building assets instead, you can alleviate some of that financial strain and improve your overall well-being. Owning assets can also enhance your quality of life. With more disposable income freed up from managing fewer liabilities, you can invest in experiences that enrich your life, travel, hobbies, or personal development. This balance between financial responsibility and personal fulfillment is essential for a happy, well-rounded life. Now, can assets ever equal liabilities? Yes, in accounting, there's a principle that states assets must equal liabilities plus equity. This balance is crucial for accurate financial reporting. If you have $100,000 in assets, you must also account for $100,000 in liabilities or equity. This principle ensures that businesses maintain transparency and accountability. So, how do you value your assets and minimize liability risks? Start by reviewing your financial situation. Identify potential risks associated with your assets and liabilities. Make sure you have adequate insurance coverage to protect your assets from unforeseen events. Keeping accurate records of your assets and liabilities is essential for understanding your financial health. Stay informed about the laws governing your financial situation and communicate openly with creditors to avoid misunderstandings. In some cases, filing for bankruptcy can be a strategic move to protect yourself from overwhelming debt. And don't hesitate to seek help from financial advisors who can guide you in managing your assets and liabilities effectively. In conclusion, valuing assets over liabilities is not just a financial strategy, it's a mindset that can lead to greater financial security and peace of mind. By focusing on accumulating and managing assets while minimizing liabilities, you can create a solid foundation for your financial future. Remember, it's not just about the numbers on a balance sheet, it's about the opportunities and freedom that come with owning valuable assets. As you navigate your financial journey, keep this principle in mind, and you'll be better equipped to make sound decisions that benefit your overall well being.